So what we're going to look at now is how we define what an operating, what an investing, what a financing cash flow is, how we set up the presentation for it, and then actually work through an example that we need to work through. So we report cash flows by operating, investing, and financing because they tell us very different things about the business. And so it's set up, companies have to do it that way. Now, what's interesting, let's get to it with operating, is the idea with operating is it tells you, not surprisingly, how the company is operating. It tells you, is it making money from actually selling things? Is it making, what it's spending on its suppliers, on its employees? So it tells you what's actually going on with the business. And that's a pretty important one, because if you're going to invest in a business, their operating cash flows don't have to be positive right now, but you are expecting those operating cash flows in the longer term to turn positive and be positive. So you want to see ultimately it's making sales. Now that's the interesting thing with a lot of these acquisitions and with tech companies more generally. When Facebook went IPO, before that you didn't have access to any of its information. When it went IPO, it actually told you what was going on. And funnily enough, Facebook actually made, well, they do still, but they actually make a lot of money. I think it was in the order of $1 billion of sales a year. And that was back 2 or 3 years ago. And you think, I've never spent $1 on Facebook. I don't know if any of you guys have spent $1 on Facebook. Maybe you have. Where does Facebook get its money from? Where do you think it gets its money from? Well, they certainly do have a lot of personal information. I don't know if they're making that much from selling it directly, but what does it use that personal information for, and what does it sell? It sells access to something, and who finds that useful, apart from governments, who obviously, yeah, ads. When it went IPO, 85% of the money that it generated was from marketing and advertising. That's where it makes its money. The issues that Facebook had, and you saw when it went IPO, the share price, it didn't crash, but it definitely dropped from its release price, was concerns that had been too hyped up that they weren't too sure where it was going to generate new inflows from. I mean, it was always going to have advertising, but as the world has gone increasingly mobile, the issue Facebook faced was that there's limited screen real estate on your phone, and they couldn't figure out how to get ads in there properly. I think they're starting to work around on that. But the other thing that they've done is they have changed the way the algorithms work for if you run a page, and a lot of companies do, when a page puts out a post, it hopes that the people that follow the page and that like the page will actually receive that post. Facebook is slowly changing that algorithm, so the numbers of people that actually see that are dropping. So initially, I think it was like 12% of the page likes would actually see that post from a company. It's now down at 6%. They're working down to 1%. And the reason they're doing that is they want people to pay to boost their posts. That is a money generation tool for them. So how a company generates cash is really important. When they spend, I know we've talked about Snapchat before, haven't we? Yeah. It doesn't make money, and it was bought for some ridiculous sum of money. And that's the issue with a lot of tech companies, and definitely tech companies back 10 or 12 years ago, was that they were trading for huge amounts of money, like on the share price, but they literally weren't selling a thing. They had no revenues at all. At the end of the day, you've got to be selling, you've got to be making money for your company to be worth something. Maybe in the short term, you can get Facebook or Google or someone to buy you out for a huge amount, but at the end of it, you've got to be able to make money. And that comes from your operating cash flows. Investing cash flows. This is when you invest in non-current assets. So you're investing in property, plant, and equipment. You might be investing in companies. So what we saw just at the start of today with Apple agreeing to purchase Beats for $3 billion, I haven't read through the details of that. I don't know whether that's a cash offer, whether that's a cash and share offer, whether it's purely share-based. I don't know. It could well be cash because Apple is sitting on from what I know, a fairly large stockpile of cash. So it could well be all cash. If that is cash that they spend on this, that is an investing cash flow. You would see it crop up here. If they've sold off businesses, you'll see that crop up here. If they've bought property, plant, and equipment, you'll see it here. If they sold it, you'll see it here. Now, whether or not you want to see that as positive or negative, it may well be negative, and that may not be a bad thing. So we're getting more into the analysis side of things at the moment, but just because you see a cash flow being negative doesn't mean it is a bad thing for the business. When you buy a house or an apartment, you know, assuming that house prices in Sydney just don't keep going to stupid levels, that is it. That is an investing cash flow. That is net cash going out, and that is a good thing. Like, you have bought a property. Well, assuming that you think buying a property is a good thing, but let's say it is, that is a good thing. But you're going to see negative cash flows from in that particular year. So really how you judge whether or not that is a good or a bad thing is much more building into the strategy of the company, whether you think the actual acquisition was warranted. So News Corp back, it's probably 10 years ago now, when they bought MySpace for about $600 million, you know, that was obviously with the expectation MySpace was going to make money, and it didn't. So it turned out that was not a good acquisition. But that's where you need to look at more deeply than just the numbers. And financing cash flows are where you generate your money from in terms of financing points of view. So you can either internally generate your funds, which don't come up here, that's from your operating cash flows, or selling property, plant, and equipment or non-current assets, excuse me, through your investing cash flows. But financing is when you're going out to the markets. If you're going out for an IPO and you're raising money through a share offering, whether it be an initial offering, whether it be going back to the markets for a second round or a third round, that is cash coming in, that is financing cash flows. Whether or not you've just gone and borrowed money from the bank, whether it's a public debt issue, when it's money coming in through a financing point, that is going to be picked up as a financing cash flow. If you're buying back shares, if you're paying off debt, not the interest portion of it, the actual paying off the debt, that's going to be picked up in the financing cash flows. So that's what we're picking up here. So some details about this. Generally speaking, reporting cash for operating cash flows, you will show the gross payments and receipts. So if I receive $100 from you for providing, whatever, selling you something, I would show $100 coming in. I've paid $80 for that particular good. I'd show $80 going out. I don't show just a net inflow of $20. But there may be times, and it's, again, probably not something we're going to see, where you actually just show the net. So if you're paying rent at the moment, and you're paying your rent to an agent who then pays the landlord, the agent, if they had to account for it under 107, would only, from what I understand, would only pick up the net amount. So they wouldn't show, $300 a week coming in and then sort of the $280 or whatever they spend that goes out. They would just pick up the $20 marginal that they're actually getting in from that case. You can use the direct or indirect method. Now, the direct method is what we're going to be focusing on in this topic. So we're not looking at the indirect method. We're not looking at how you calculate it. And the reason for that is that even though in Australia the indirect method is allowed, and it was allowed back, that changed in about 2009. Now the thing is, even though it was allowed back in 2009, only about 10 companies, at least when we last looked at it, only about 10 companies in Australia actually used the indirect method. Basically, no one does. You have to use the indirect method as a reconciliation if you use the direct up front, so just that point there. But very few companies use the indirect alone. So they generally use the direct, which is what we're going to go through, and then the indirect later on. For cash flows from investing and financing, again, it's mainly gross receipts and payments, and just done by the major classes. Interest and dividends. I've borrowed money, that's a financing cash flow. I am repaying that money. The principal repayment is a financing cash flow. The interest repayment, the interest portion of that, well, I don't know. It's the cost of financing, so you could argue that it is a financing one. But then you borrowed that money to fund the purchase of property, plant, and equipment. So the only reason you had that money in the first place, and the cost of that money is related to property, plant, and equipment. So is it an investing cash flow? Because that's the cost of that. Is it just general borrowing to keep the company ticking over? That's just normal part of operations. Is it an operating cash flow? And it could actually be any of them. So when we say that things have to be consistent, that's not entirely true. Companies can actually pick for interest and dividends where they put them. So you will see for some companies, they will call interest payments as part of operating. Some will call it part of financing, some will call it part of investing. It actually can be different. When we do the practical example, we'll see which one we generally use, but as long as you pick one and are consistent, that's okay. Tax, for all that tax, well, obviously companies do pay some tax. We've seen a lot of companies not paying tax, but tax is generally done as operating. Again, you could argue that it's being involved with financing and investing, but generally tax and what we'll use it as is operating. Subsidiaries. So what we were talking about before with BEATs, so if you've had acquisition or disposals picked up in investing cash flows, the analysis of the acquisition, you guys have discussed probably at length in ABC. It's not really something that we're that interested here, but just be aware of that. Funnily enough, from a cash flow statement, the non-cash bit of it is not included. Who would have thought? So we don't include those non-cash components in there. Even things like if you've got a conversion option, and we've looked at convertible instruments where you might take an equity position instead of actually getting paid out cash. In that case, there hasn't been a movement in cash, you don't pick it up. Reconciliation of cash flow statement in the balance sheet. So you should see somewhere that the numbers which you see in the cash flow statement are the numbers which you see in the balance sheet. I'd be a little bit worried if you had a company and then that did all this information, had an ending cash flow, and that cash flow number wasn't the same as what's in the balance sheet. Like that would be somewhat concerning. Not so much that they've tried to get one over on us, but it's just that company's not very good. They should get those things correct. Now, unused facilities. If you've ever borrowed money in Australia, actually pretty much anywhere, if you've gone for a credit card, if you've gone for a mortgage, if you've gone for a car loan, personal loan, whatever, you might not, it won't be asked in this particular way, but you'll actually get asked about this. And so we're going to talk about why that's the case. So when I went and bought my car, God, 5 years ago now as well, I had to take out a car loan for that, and filled out all the paperwork and had forgotten, because I'd actually taken out a line of credit with GE. It didn't cost me anything to do it. I think it was about a $15,000 line of credit. It was, I think, an interest rate of 1% for a year when I took it. So I went, well, it's basically free money if I need anything for it. Never used it once, promptly forgot about it, and it was just sort of sitting there in the background. So I filled out all the paperwork for my car loan, put it in, and they came back and was like, you've got this $15,000 line of credit with GE, like what's all that about? And companies and lenders want to know this information. And the same holds true with credit cards. If you go for a loan and you've got a credit card, and let's say that credit card is a $5,000 limit. What that is saying is that bank or whoever that credit card provider is saying, we are happy just off the cuff to give you $5,000. You'll get charged an arm and a leg for it. It's like 20% interest. It's expensive. But if you want, you could go down in the ATM, withdraw $5,000 in cash right there and then and walk away. You'll get charged a lot for it, but you could do that. Most of us won't take out money in cash from credit cards because it is costly from the very get-go. The money that you spend, you'll generally get an interest-free period. So let's say we've got this $5,000 limit on our credit card. I've gone off, done some shopping with it, put all my groceries on Woolies and whatnot, and at the end of the month, there's a $1,000 balance sitting there. So I owe the bank $1,000. I have $4,000 left available. The $1,000 will get picked up as a liability, and we'll see, so that's for me a liability. I see that I owe the bank $1,000. The unused portion is the $4,000. And if you go and apply for another credit card or a bank loan or a mortgage or whatever it happens to be, they want to know how much your balance is, so how much you currently owe, but they also want to know what your limit is, because they want to know what you're on the hook for now. They also want to know what you have access to. Because, and this is what the credit card company, so the car loan company was wondering about it for me. It was like, I have approved a $15,000 line of credit. So if I've got that $15,000 line of credit, why didn't I just take out money from that? Because I could just do that straight away. And that's the concern that I suppose lenders have or users have, is they don't want to know just how much money you owe right at the moment. They want to know what you could get access to really, really quickly. And that's what an unused facility is. So on that credit card, the $4,000 which is unused, I could, if I wanted to, just take that out of the bank or just go on a shopping spree and spend $4,000 on things. And the next lender cannot stop me doing that because I'm approved for it. So they want to know what these things are, and it will help guide decisions about lending. So that's what an unused facility is. Now, for us, maybe one of you guys may well end up in this situation. I imagine for most of us, most of our credit cards will have a limit on it. You hear about the rich and famous, they have no limit credit cards. They can just basically go off. They've been approved to spend as much as they want. Which I don't know, good luck to them, I suppose.